For longer when it comes to oil and when it comes to rates. How does the market perform in that environment? Ross Mayfield is investment strategy analyst at Baird and joins us now. I can't see a bull market sort of going gangbusters in that environment, Ross. How are you thinking about those two factors?
Yeah, I agree. I mean, you need at least one of those things to crack a little bit if you want to kind of resume this bull, or depending on how much the market, falls from here in order to start a new bull. I do think, higher rates, higher oil, higher dollar, all weights on the bottom lines of U.S. companies, and especially the big multinationals that take in oil as an input cost and have exposure to different currencies. So it's definitely big headwinds. We probably need to see rates crack first. We need the Fed to kind of ease off their hawkish policy. But in the near term, it is a challenging macro environment for sure.
One thing that could get them to perhaps lean that way a little bit more suddenly than the market is looking for is if something breaks. And we've been making the point that rates are now higher than they were and have risen just as quickly than when Silicon Valley Bank collapsed. How concerned are you about one of those, black swan events, whatever you want to call it, are waiting for us right around the corner?
I think you have to be concerned about it. I mean, obviously the risk comes from it's an unknown, right? We don't know what it might be, leading up to the Silicon Valley Bank failure. It was not widely talked about. And then all of a sudden it was, and over the weekend it was gone. But this is kind of the history, right? The Federal Reserve raises rates until something breaks, and then they ease off, the policy, and the bull market can start anew. The difference this time is that their emergency policy to kind of quell the banking crisis in March worked. Inflation, continued to come down, but didn't break, and economic growth didn't break either. So they kind of just looked around and resumed on their path upward. So yeah, with rates at these levels and with the speed of the move off 0% just last year, I do think you have to worry about, something breaking. And again, when it's rates moving that fast, that far, it's hard to know what it is in advance.
It sounds like you're cautious here, even as we see markets recovering today, that this is not something you'd want to enthusiastically buy.
Well, I think it always just depends on your time horizon, right? I think longer term, the setup for the market is still okay, right? We're still at, roughly peak Fed. Maybe they want one more hike. Maybe they want higher for longer, but we have most of the rate hike cycle behind us. Corporate fundamentals have held up really well. I think that's one thing, because of all the other big macro drivers that's not being talked about and will come back into focus, in the next 4 to 6 weeks as we hit an earnings season, is that corporate operators held up really well in the face of what was expected to be an earnings recession in 2023. So there are still catalysts, to move higher over the longer term. And even near term, we have a seasonal headwind shifting to a seasonal tailwind. Sentiment has gotten pretty negative. But I do think, at a minimum, at a baseline, you need to have one of those big three crack in order to get a bull market really going again. And right now, there's just not a clear path on what that will be and when it will be.
I mean, at the same time, you look under the hood of the S&P 500, we don't have an official correction, but a lot of, nearly 3/4 of the S&P 500 has already pulled back 10% from 52-week high, if not more. Does that create more opportunities?
Yeah, I think so. Look, the equal weight S&P 500 has really diverged from what the cap weight S&P 500 has done. Small caps have broken down. So valuation at the index level still looks, pretty elevated for where rates are, I would say. But if you do strip out some of those big weights and look to some of the more opportunistic sectors, something like energy has done over the last couple of months, some really good value there. And we think there are some sectors and some names, individual names, where there can be more value had on a valuation basis. If you look past the broad headline index, at this point, all that headwinds circulating, we do feel pretty late cycle. We'd want to be looking towards quality. And if that meant paying a premium for quality, either in equities or fixed income, we would probably want to do so at this point. But there's value to be had. You just have to look past kind of this headline, Magnificent Seven or big mega cap stocks that drive the S&P 500.
What is quality? Is it balance sheet? Is it in a certain sector?
Well, I think right now it is more about the fundamentals of the business and less about the sector specifics, right? So you want to have a low debt burden in a rising rate environment. Having to refinance at these levels is a meaningful headwind. Cash on hand is nice because not only can you avoid taking out debt, but you're earning something on that cash for the first time ever. So strong free cash flow coming in, low debt. We see in a rising rate environment that the shorter duration stocks tend to outperform as well, and usually generating your own free cash flow is a big part of that. So I would think of it less as a sector play and more of a, let's look at the fundamentals of the business. And I think across all 11 sectors, you can find high quality and low quality. Your sector tilt is up to you, but we would want to stay high quality at this point.
All right.